and welcome to Business Line. Greece's main stock index fell sharply when it finally reopened on Monday after a 5-week closure. That's when investors got their first opportunity since late June to react to the country's latest economic crisis. No surprise, the bank stock suffered the most, hitting the daily trading limit of a 30% loss. The Athens Stock Exchange and the country's lenders were closed on the 29th of June. Since then, Greece has moved away from the brink of Grexit to the third bailout talks. Our business correspondent in Athens, Symela Touchtidou, asked the chairman of the Hellenic Capital Market Commission whether the first trading day was surprising.
The main Greek stock index, the ATHEX, ended the day down by 16.23%, recovering from a 22.87% drop minutes after opening. The bourse has been closed for 5 weeks, shut just before Athens imposed capital controls at the height of the debt crisis. Bank shares, which make up about 20% of the index, were particularly hard hit. The overall banking index was down to its 30% daily limit. It was the worst daily performance since at least 1985, when modern records began. Given that the market has been closed for a protracted period and many things remain uncertain concerning the Greek economic situation, uncertainties that we hope will clear up soon, we expected that there would be pressures on the Greek Stock Exchange as soon as it opened. But allow me to say, that was no excuse to keep the stock market closed and never open it. A closed stock market is no market at all. Some commentators reported there had been thoughts of prohibiting the trading of bank stocks. The massive sell-off was expected as the banks face new stress tests and a further recapitalization process. Traders said they predicted more bank shares losses in the next session. Market analysts say that Monday's sell-off was something to expect. What is crucial now for the stock exchange and for the Greek economy as a whole is the sell-off not to be accompanied by a massive exodus of foreign investors, something which will be revealed in the coming days.
Symela now joins me from Athens. Let me start with your report. If the sell-off was so predictable, wasn't it easier to ban at least the bank stocks trading?
Sasha, let's explain why the Greek banks got hammered. The capital bleeding they have been suffering all these months have brought forward the need for yet another recapitalization. There are a lot of scenarios of how this will happen, but in any case, things do not look promising for the shareholders. Most likely, they will lose part or even all of their investment. That's why they try to get rid of their bank stocks at any price. There have been thoughts to ban the trading of the bank stocks at least for a short while. But as the president of the Hellenic Capital Market Committee told us, even bankers rejected this idea. They want the market to do its job, show the true evaluation of the Greek banks, so the third recapitalization that will take place, hopefully it will be the last one.
One more question on the banks. There are reports that since the government closed the lenders for 3 weeks and imposed capital controls, about 1 million debit cards have been issued. Is that right?
Yes, and this is one of the very few positive things that came out of the capital controls. Traditionally, Greeks like to do business with cash. This is the case even for purchases as big as consumer electronics or used cars. The problem is that cash payments support the black economy. Business and entrepreneurs do not issue receipts, and thus they do not pay the appropriate taxes. This is why tax evasion has always been on the top of the agenda of every Greek program. There is hope that the cash shortage will establish a card payment mentality in Greece, and this in turn will reduce the black economy that now accounts for almost 1/5 of the Greek overall GDP.
Symela, according to latest figures, Greece's factory output fell to its lowest level on record in July. What's been happening to the manufacturing sector during this crisis?
Capital controls have been the last blow for the Greek manufacturing sector. Deprived of the ability to send money abroad, factories could not buy materials, and it was only natural they reduced the production to the minimum. Add to that the plunge of the retail sales and the elimination of the consumer's appetite for purchases. Supply and demand hit rock bottom in July. This resulted in further job losses. In the market manufacturers PMI, July signaled the steepest drop in factory employment recorded in the 16 years of data collection.
That was our business correspondent in Athens, Symela Touchtidou. Symela, thank you very much indeed.
Thank you.
And from Greece to another crisis that could be even more dangerous. The factory activity in China has contracted the most in 2 years. The country has been recently hit by a series of disappointing data. Moreover, in some cases, weak figures in China mean bad news in the other part of the world.
No longer a sought-after must-have vehicle in China. Luxury car maker BMW has been hit by a downturn of sales in the world's biggest car market. The Munich-based company said that net profits fell to 1.75 billion euros in the second quarter, down from 1.77 billion euros a year earlier. Japanese giant Toyota reported a 10% increase in profits for the first quarter of its fiscal year, helped by the weak yen and cost cuts. But the company also saw a drop in sales in Asia. Brake has been applied to the car market in China with the economic downturn, the fall of the Shanghai Stock Exchange and the fight against corruption applying the pressure. The number of vehicles sold in June shrank by 3.4% from a year earlier, while production fell by 0.7%. According to the China Association of Automobile Manufacturers, it is the first decline combined since December 2008. The figures have led to a revision of forecast for growth in the market from 7% to 3% for this year.
BMW is looking for the way to a customer's heart, not only in China. And it could be that the company has finally found the way to get here. This is it. This is IT.
Nokia's digital maps just set a new destination, Germany. The Finnish company sold its HERE unit to a group of car makers composed of BMW, Audi and Mercedes' parent company Daimler. The price tag is 2.5 billion euros and it includes location technology patents and databases. A real treasure of mapping assets whose future had been in doubt ever since Nokia decided to focus on its merger with Alcatel-Lucent. No word yet on the fate of more than 6,000 employees, but experts say the headcount was one of the reasons Nokia decided to sell. Now, why exactly did these car makers decide to snatch HERE away from tech giants such as Uber, Amazon and Alibaba? Well, for starters, geolocalization services are essential to provide autonomous driving. Simply put, a car can't drive itself if it can connect to a mapping system telling it where it is and where it's going. Secondly, HERE's main competitor is Google Maps, and the search engine has been reportedly experimenting with cars for a while now. So the picture that emerges is one where car makers and tech giants are vying for the car of the future. They could work together, of course, but when Daimler's CEO talks about securing the independence of the central service, it sounds like a declaration of war. That was it. That was IT.
And that was it for now. Thank you for watching and we'll see you next week.